Welcome to Charged Alpha's Q1 2026 earnings coverage. Today we're diving into Abbott Laboratories, a company that's been quietly transforming healthcare for over 130 years, from the glucose monitor on your arm to the pacemaker keeping your heart in rhythm. And right now, it's sitting near 52-week lows, despite what might be its strongest fundamental setup in years.
And the timing matters. Abbott just closed a major acquisition, Exact Sciences, stepping into cancer diagnostics in a meaningful way. On April 16th, they reported Q1 numbers. Revenue came in at $11.6 billion, beating estimates by about $165 million. Adjusted EPS hit $1.15, a penny ahead of the street. The stock's down about 30% from its 52-week high of $139. And the question is whether that's a buying opportunity or a warning sign.
That's the debate we're going to unpack today. 4 business segments: a blockbuster cancer diagnostics acquisition, a monster CGM franchise that's adding AI, and a $70 million baby formula verdict that's casting a long shadow. This is not a simple story, and I love it for that reason.
Management guided for an acceleration in the second half of 2026, and CEO Robert Ford is backing it up with $2 million of his own money. So the conviction is there. Let's see if the numbers support it.
Let's get into it. Let's set the stage. Abbott Laboratories was founded in 1888 by Dr. Wallace Calvin Abbott, a physician frustrated by the inconsistency of crude drug dosimetry. He started manufacturing standardized dosimetric granules, basically standardized pills, in his house in Ravenswood, Illinois. Fast forward 137 years, and Abbott is a $168 billion healthcare company with 114,000 employees operating in over 160 countries.
And the company operates 4 segments. Medical devices is the crown jewel, cardiovascular equipment, diabetes care, including Freestyle Libre, and neuromodulation devices for pain management. Then you have diagnostic products, nutritional products, which includes Ensure and Similac, and established pharmaceutical products, which covers generic drugs primarily in emerging markets.
Medical devices alone drove 8.5% comparable sales growth in Q1 2026. The Libre ecosystem, a continuous glucose monitoring sensor worn on the back of your arm, has become one of the most recognizable consumer health products on the planet. Over 6 million people globally use it to monitor their glucose in real time. And Abbott just launched Libre Assist in January 2026, which uses AI to predict how food choices will affect your glucose before you eat.
The CGM market is a $15 billion annual opportunity, and Abbott and Dexcom essentially own it, but with different customer profiles. Abbott dominates the Type 2 and lifestyle monitoring segment with a lower price point and pharmacy accessibility. Dexcom leads among insulin-dependent patients who need tighter integration with insulin pumps. They can coexist, but competition is intensifying.
In cardiology, Abbott is a full-stack electrophysiology player thanks to the 2017 St. Jude Medical acquisition. Pacemakers, implantable defibrillators, ablation catheters, and remote monitoring. They just launched Volt, a pulsed field ablation system for atrial fibrillation. PFA is a safer, faster alternative to traditional radiofrequency ablation, and Abbott is one of the first to market with CE mark approval.
And then there's the biggest news of Q1. The Exact Sciences acquisition closed March 23rd, just 3 weeks before quarter end. This brings in Cologuard, the non-invasive colorectal cancer screening test that's growing at 13% annually, plus CancerGuard, an emerging multi-cancer early detection test. This adds roughly $3 billion to Abbott's 2026 revenue outlook.
So the moat here is multi-layered. Freestyle Libre's data network effect, a full EP device ecosystem, consumer brand trust in Ensure and Similac, global scale, and now a new cancer diagnostics franchise. No single product failure kills the company. That's diversification with depth.
That said, this is not a hypergrowth story at the top level. Abbott is a steady quality compounder. The Exact Sciences deal is management's bid to add a faster-growing vector to what's already a very stable platform. Whether that deal earns its price tag will define the next 2 years.
So who is leading this 137-year-old institution? Robert Ford has been Abbott's CEO since March 2020. He joined the company in 1996, specifically through the diabetes care division, the very franchise that eventually became Freestyle Libre. He climbed through medical device ranks over 2 decades, ran the cardiovascular and neuromodulation businesses as EVP, became president and COO in 2018, and took the top seat at the start of COVID.
His leadership was tested immediately. Abbott pivoted its entire diagnostics operation during COVID to develop 4 new tests in 2020 alone, shipping over 400 million units. That's an extraordinary operational feat, pulling scientists and manufacturing teams off existing projects and converging them on a single urgent mission. It established Ford's reputation for speed and execution.
His strategic vision now centers on the consumer health monitoring revolution. He talks consistently about connected devices, smartphones, and turning passive health data into actionable behavioral insights. The Libre Assist AI launch in January 2026 is a direct expression of that thesis, turning a glucose monitor into a proactive food coach using the real-world data from 6 million users.
He's also the architect of the Exact Sciences deal. Ford's thesis is that diagnostics and devices are converging, that a hospital system using Abbott's EP devices should also use Abbott's diagnostic stack and now Abbott's cancer screening tests. Vertical integration across the patient care continuum.
And Ford put $2 million of his own money into Abbott shares at roughly $107, well above where the stock is today at $97. That's his largest documented insider purchase. When a CEO is buying at prices above the current market level, that's a signal worth paying attention to.
Let's dig into the financials. Abbott is trading at $96.61 with a market cap of $167.9 billion. On a trailing 12-month basis, the GAAP price-to-earnings ratio is 26.9 times. But that GAAP number is heavily distorted by amortization of acquired intangibles, about $29.5 billion in goodwill and intangibles from St. Jude Medical and Exact Sciences on the balance sheet. Strip those out, and Abbott's adjusted forward PE is closer to 17.6 times, historically cheap for this name.
So valuation at a glance, price to sales is 3.72 times on trailing revenue, price to book is 3.24 times, EV to EBITDA is 16.1 times. For reference, Scientific trades at roughly 18 times EV to EBITDA with faster revenue growth. Abbott at 16 times is interesting value if the Exact Sciences deal delivers.
Now revenue. Q1 2026 came in at $11.6 billion, up 7.8% year over year from Q1 2025's $10.36 billion. The trailing 12-month revenue run rate is $45.1 billion. Medical devices grew 8.5% on a comparable basis, the standout segment. Diagnostics grew 2%. Nutrition was steady, and established pharma contributed its usual modest share. With Exact Sciences now consolidated, Q2 will look very different on the top line.
What do margins look like?
Gross margin is 56.4% trailing, a highly defensible profitability profile. Operating margin is 18.2%. Net margin on a GAAP basis is 13.9%. Return on equity is 12.5%. Return on assets is 7.5%. These are not the highest margins in medtech, but they're stable and improving. The cash economics are substantially better than the GAAP income statement suggests because of all that intangible amortization.
And the income statement for Q1 specifically?
Revenue $11.6 billion, gross profit $66.28 billion. That's the 56.3% gross margin. Operating income $1.84 billion. Net income $1.8 billion on GAAP EPS 6.2, adjusted EPS 1.15. The 53 gap between those two EPS numbers is almost entirely the amortization of acquired intangibles. This is why the Street almost exclusively focuses on adjusted EPS for companies with large M&A histories.
Now cash flow, because that's where Abbott really distinguishes itself.
Trailing 12-month operating cash flow through Q4 2025 was $9.6 billion. Free cash flow, operating cash flow minus capital expenditures, was $7.4 billion. That's a 16% free cash flow margin on a $45 billion revenue base. For context, Abbott pays about $4.2 billion in annual dividends and buybacks combined, so they're generating significantly more cash than they're returning to shareholders, giving them ample room to delever from the Exact Sciences acquisition.
Balance sheet?
As of year-end 2025, the most recent full balance sheet, Abbott held $8.5 billion in cash. Total debt was $15.1 billion, giving net debt of $6.5 billion. Net debt to EBITDA is just 0.57 times, extremely conservative leverage for a company this size. Current ratio is 1.58, meaning they comfortably cover near-term liabilities. Debt to equity is 0.29 times. The Exact Sciences deal added to the debt load, but the free cash flow generation means this delevers quickly.
And dividends. Abbott is a dividend aristocrat, right?
52 consecutive years of dividend increases. The current annual dividend is $2.44 per share, yielding 2.53% at today's price. Payout ratio is 65.6% on a GAAP basis, but on a cash basis, it's well within a comfortable range. They also repurchased $302 million of stock in Q4 2025. This is a company that prioritizes capital return, even while funding acquisitions.
Overall verdict on financial health?
Overall, Abbott's financial health is solid. The $7.4 billion in annual free cash flow is the engine that powers everything else. The dividend, the deleveraging from Exact Sciences, and the continued R&D investment in Freestyle Libre and the EP franchise. The NEC litigation is a wild card that could cost up to $3 billion over time, but even that's manageable against a $7.4 FCF base. This is a financially durable business.
Let's talk about what the street thinks, because the analyst sentiment after Q1 earnings was pretty unanimous.
Wall Street is broadly bullish. After the April 16 report, firms including BofA Securities, Stifel, BTI Benchmark, Evercore ISI Group, and RBC Capital all maintained buy or outperform ratings. Goldman Sachs had already reiterated buy a week before earnings. Barclays is overweight. Out of approximately 28 analyst ratings, 22 are buy equivalent, 4 are hold, and none are sell. The consensus is about as strong as you see on a large cap name with ongoing litigation risk.
And price targets? Because the stock at $97 is a long way from where it was 6 months ago.
The consensus price target sits around $140, implying roughly 45% upside from current levels. The target range runs from about $150 on the low end to $165 on the high end. Analysts who maintained their targets essentially said Q1 results validated the second-half acceleration thesis and that the pullback from the 52-week high was entirely macro-driven, not fundamental. That's an important distinction.
The real test comes on July 16th, when Abbott reports Q2 2026. That's the first full quarter of Exact Sciences' contribution. The street is penciling in $1.30 adjusted EPS and revenue of $12.4 billion. If Abbott delivers that, the acceleration narrative gets confirmation. If they miss on Exact Sciences integration, the stock has further to fall. All right, let's lay out both sides. I'll take the bull case first. Abbott is sitting near a 52-week low, while the fundamentals are at their strongest in years. You've got a company that just beat on both revenue and EPS in Q1, generating $7.4 billion in annual free cash flow, paying a 2.5% dividend, and just acquired what could be the fastest-growing diagnostics franchise in the country at a price that only added moderate debt to an already conservative balance sheet.
The Exact Sciences bull case is real. Colorectal cancer is the second leading cause of cancer death in the United States. Only about 57% of eligible patients are currently screened. Cologuard is non-invasive and backed by strong clinical evidence. If Abbott can bring its global distribution, hospital relationships, and direct-to-consumer marketing muscle to Cologuard, the addressable market expansion is enormous. And CancerGuard, the multi-cancer early detection test, could be the next leg up in the cancer diagnostics story.
And on Freestyle Libre specifically, the data moat is compounding daily. Libre Assist launched in January 2026, adding AI-powered food prediction to the CGM. You've got 6 million users generating real-world glucose response data. Dexcom cannot replicate that proprietary dataset quickly. Every day, Abbott's Libre is on someone's arm. The competitive advantage gets harder to replicate.
Volt, the pulsed field ablation system, is a third tailwind. PFA is the next-generation approach to treating atrial fibrillation. Faster procedures, less tissue damage, faster patient recovery. Abbott is among the first to market in Europe. As the U.S. clinical pathway progresses, this becomes a meaningful driver of EP segment growth on top of pacemakers and defibrillators.
And the pure valuation argument, 17.6 times forward-adjusted earnings for a 52-year dividend aristocrat with $7.4 billion in annual free cash flow and multiple growth catalysts. That's historically in the bottom quartile of Abbott's own valuation range. History says that's when you buy quality companies, not sell them.
Now, the bear case. The NEC baby formula litigation is the most material near-term risk. A Chicago jury awarded $70 million in damages in April 2026. There are now 782 lawsuits in the multi-district litigation. Analyst estimates put total exposure for Abbott and Mead Johnson combined at up to $3 billion. And here's the asymmetry. Each jury verdict sets precedent, potentially accelerating new filings. Abbott disputes the science, citing FDA findings that no conclusive causal link exists, but the courtroom risk is real and not going away soon.
And Dexcom isn't standing still on CGM.
Correct. Dexcom's G7 15-day sensor is actively expanding down-market into the Type 2 non-insulin segment, Abbott's home territory. Dexcom's AI and Apple Watch integration arguably surpass Libre Assist today. If major payers start covering the G7 for Type 2 patients at cost parity with Libre, Abbott's volume advantage erodes. The competitive moat is strong, but not permanently impenetrable. This is a watch item every quarter.
The Exact Sciences integration is the other bear risk.
Exactly. This was a $2.1 billion acquisition of a company that was GAAP loss-making. Abbott is absorbing 20s of EPS dilution in year one. Large healthcare acquisitions have a mixed track record. If the integration lags, if Cologuard reimbursement comes under Medicare pricing pressure, or if key Exact Sciences talent exits during the transition, the deal disappoints. The optimism is justified by the strategic rationale, but execution has to be earned quarter by quarter.
Let's see how Abbott stacks up against the peer group. Boston Scientific, Medtronic, and Stryker are the natural medtech comparators.
Boston Scientific is the most interesting comparison right now. BSX completed the Penumbra acquisition earlier this year, making them the undisputed leader in neurovascular intervention. Their most recent quarter showed 15.9% revenue growth versus Abbott's 7.8%. Boston Scientific trades at roughly 5.5 times price to sales versus Abbott at 3.72 times. If you're choosing between the two on pure growth momentum, BSX wins. If you want more diversification, lower beta, and a dividend, Abbott wins.
Medtronic is the contrast case.
MDT is the underperformer in this cohort. Their most recent quarter showed 4.9% growth versus Abbott's 7.8%. Medtronic trades at roughly 3.0 times price to sales, cheaper than Abbott, but arguably for good reason. They've been losing EP market share to Abbott and Boston Scientific for several years. Abbott is the technology leader in EP right now with Volt, while MDT is playing catch-up. The discount reflects structural challenges.
And Stryker is in a different lane, but it gives you a benchmark for quality premium. SYK trades at about 5.2 times price to sales versus Abbott's 3.7 times. The market is paying a significant quality and growth premium for Stryker's consistency in orthopedics and surgical robotics. Abbott at 3.7 times is cheap relative to that benchmark, particularly if the Exact Sciences deal closes the growth rate gap. Anything notable in the options market around these earnings?
ABT's implied volatility tends to run low for a large-cap healthcare name. It's a defensive stock with consistent earnings. The options market priced in roughly a 4 to 5% move in either direction ahead of the April 16 report. The put-call ratio was approximately 0.90 heading into the number, basically balanced with a slight put lean reflecting the NEC litigation overhang and broader macro tariff uncertainty. Post-earnings, IV crushed as the inline result removed near-term uncertainty. IV percentile is in the 28th percentile historically, very low for an earnings week.
No unusual positioning, no large block trades signaling information advantage. This is a name where the smart money is largely indexed or holding for the long-term thesis, rather than playing short-term options volatility. Insider activity is where this story gets interesting.
Very interesting. Over the past 3 months through April 2026, Abbott insiders spent $3.1 million on stock purchases versus only $485,000 in sales, a 6.4 to 1 buy-to-sell ratio. The standout is CEO Robert Ford's $2 million personal purchase at approximately $107 per share, his largest documented insider buy. He was buying at prices meaningfully above today's $97 market price, which makes that purchase even more significant as a conviction signal.
When a CEO is buying $2 million of their own company's stock at prices well above the current market, they're either signaling genuine undervaluation or setting up a very expensive lesson. Given the second half acceleration guidance, the Exact Sciences optionality, and the Freestyle Libre AI momentum, the market is betting Ford is right. Let's talk about the risks and key watch points going forward.
3 primary watch points. Number 1, the NEC litigation progression. The coordinated MDL has 782 cases pending, and each jury verdict sets precedent. How Abbott navigates settlements versus courtroom battles will determine the eventual liability hit. The $70 million verdict in April is a data point, not a final outcome, but it signals elevated settlement pressure. Number 2, the Exact Sciences Q2 contribution, revenue of $12.4 billion and EPS of 130 cents, is what the street is expecting on July 16th. Missing that with a fresh $2.1 billion acquisition on the books would raise serious questions about deal execution.
And the third,
Freestyle Libre growth trajectory. Abbott's guidance implies acceleration partly driven by medical devices and Libre momentum. If Libre's comparable sales growth decelerates, whether from Dexcom competition, payer pushback on CGM coverage, or a slowdown in international adoption, that throws the full-year model into question. Diabetes care is Abbott's highest margin business. Any softness there hits earnings disproportionately, and the market will punish it.
let's bring it all together. Abbott is a quality healthcare platform trading at a historically low valuation, 30% off its 52-week high, while the fundamental story is actually improving. Q1 confirmed the thesis. Revenue beat, EPS beat, medical devices firing at 8.5% comparable growth, and Exact Sciences adding a cancer diagnostics franchise that barely existed for Abbott 3 months ago.
The investment decision really comes down to one thing. Do you trust the second half 2026 acceleration thesis? If Exact Sciences integrates cleanly, Libre holds its CGM share, and Core Lab Diagnostics continues its recovery, Abbott should trade at 20-plus times forward earnings, implying 15 to 20% upside from consensus targets. If any of the three main risks materialize simultaneously, NEC verdict escalation, Dexcom encroachment, or Exact Sciences integration stumble, the stock has further to fall. The key metric to watch is the July 16 Q2 result, Exact Sciences contribution and Freestyle Libre comparable growth rate.
Either way, this is a 137-year-old institution with $7.4 billion in annual free cash flow, a 2.5% yield, 52 consecutive years of dividend increases, and management betting their own money on the recovery. That combination tends to work out well for patient, long-term investors. We'll leave you with this. Robert Ford said on the April 16th earnings call, "Despite certain market headwinds, our strategic initiatives and product innovations position us well for future growth. We remain confident in our expectation for an acceleration in growth in the second half of 2026. That's the thesis in plain English from the man running the company."
And consistent with his $2 million personal purchase, it's not just words. Ford is financially committed to the outcome he's describing.
And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign-up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. And real quick, if this Abbott breakdown helped you see something you would have missed, we're doing this for every major earnings report. Hundreds of Russell 1000 deep dives, new episodes every week during earnings season. Subscribe and you'll get one of these for every stock on your watch list. Takes 2 seconds and you won't miss the next one. That's going to do it for our Q1 2026 earnings deep dive on Abbott Laboratories here on Charged Alpha. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.